Morning, respected members. During this today one-day session on seminar on the pharmacy industries to be taken, and we have here with us Mr. C.A. Anjani Khetan. I request Mr. Ramesh ji to please escort him and welcome with a floral bouquet as a token of appreciation. Please welcome, sir. I request Ramesh ji to please give the bouquet and honor him as a presentation of token of appreciation. And I take this opportunity on behalf of Bangalore branch of SARC of ICI to introduce him. A brief introduction about our CA Anjani Khetan ji is associated member of ICI with about 20 years of post-qualification experience in the leadership roles with the renowned business organizations, both industries and in big firms accountings. In addition, Anjani sir is also a CFA, an association of member of ICWA, and licensee take a member of ICSI. Anjani is currently based out of Bangalore and is working as regional head, finance in MNC companies. Anjani sir is a core competence including the managing the entire gamut of the finance and treasury, taxation, both domestic and international taxations, transfer pricings and corporate accounting, so on. Anjani sir is visiting faculty for ICI, training courses on Ind AS for the last about 4 years. Anjani sir has contributed articles in professional magazines like Chartered Accountants and Chartered Secretaries. With our latest one is Lease accounting under IFRS 16 in the August 2016 issues. More monthly journals and the Chartered Accountants brought out by ICI. With this, I request Anjani sir to please commence his important course for all of us. Thank you. Please.
Words and introduction. Good morning, everyone. My name is Anjani Khetan. So today, as you know, that we have a one-day seminar on pharma industry. Of course, apart from accounting, you are also expected to cover areas on taxation on direct and indirect taxes, transfer pricing. All of those other areas would also be covered. Now, as far as accounting is concerned, I thought that as part of our discussion, we should cover a brief introduction about what Ind AS is all about, what is the roadmap which MCA has chalked out for implementation of Ind AS in India, both for and more specifically because we are talking about the pharma industry, so I will restrict it to the corporate sector. Of course, we have separate roadmaps, as you know, for banks, insurance companies and NBFCs. So but we'll be focusing more on the corporate side of the roadmap. And then what I thought it would be appropriate that we can also look at some of the significant areas which will be impacted by Ind AS implementation. Talk about areas like revenue recognition, financial instruments, lease accounting, consolidation, and business combination. Of course, there are others as well, but I thought that these are the most significant areas which are of importance, which one should know. Okay, and then some of the key takeaways, and also since you guys are all, I assume, part of the pharma industry, so I'll not be devoting too much time on the industry as such. Of course, you are the expert of that industry, but what I have done as part of this presentation, I have put in as an appendix some of the key result areas on India's transition, how it has impacted the industry. So that is something which we have included as part of the appendix. So let's see. Start working. Okay, thank you. Okay, so first thing first, if you look at this introductory slide, I think we would be familiar with this. The fact that India has chosen to go for convergence to IFRS rather than adopting IFRS per se, and accordingly, we have our own set of literature, what we call as Indian accounting standards, which are converged to global IFRS standards. So this slide, if you see, it is basically, it gives you a mapping in terms of how our Indian standards are stack up to if we were to compare those with the global standards. So if you see on the slide, on the left hand side, if you see these first column here, you will see that there is a mapping in terms of, let's say, if globally we have IFRS 1, the corresponding literature in Ind AS is under series, so it's Ind AS 101. Okay. Likewise, if you have IFRS 4, the corresponding literature in Ind AS is Ind AS 104. But then the other series of literature under IFRS, let's say IAS 7, if you see on the second side here, IAS 7, then corresponding literature is basically Ind AS 7. So basically what we have done, against each of the global standard, we have a corresponding literature in Ind AS, which is in two different series. You see, one, say IAS 1, corresponding to that we have Ind AS 1, IAS 7, we will have corresponding literature as Ind AS 7. Okay. Now, what is also important to know that starting this financial year, 1st April 2018, we have a new standard on revenue recognition, that's Ind AS 115. So that is a new standard, relatively speaking, and now we are expected to have a new literature, new standard on leases starting next year, which is 1st April 2019. We will have a new standard on leases, which will replace the existing literature, and the new standard will be known as Ind AS 116. So as we go along, we will see not only the revenue standard, but also we will see how Ind AS 16 will bring some of the changes to the financial reporting world. Okay. Now this is again a preliminary slide to just give you a perspective of how things are going to change when we move from Indian GAAP to Ind AS. So if you look at some of the significant impact which one is likely to see is, say for instance, a greater emphasis under Ind AS on substance over form. So if you look at today, it's a very simple example if you were to draw. If you look at compulsorily convertible preferences. Now today under Indian GAAP, those are considered as equity. Okay. However, under Ind AS and IFRS, these compulsorily convertible preferences are no longer considered as equity, rather they are considered as debt. The reason is because the substance of the instrument is that the entity does not have, it has an obligation to redeem those compulsorily at a subsequent point in time. So hence, they are actually not in the nature of equity, but essentially takes the character of a debt. And because of which, the moment you consider those as debt, there will be a lot of other implications, in the sense that whatever the dividend which you pay on those redeemable preferences, basically they take the color of a debt interest, which means what? If it is first, because it is considered as a debt and no longer as equity, your debt equity ratio will change. then because of the fact that you will have payout on those preference shares to be considered as interest, which means your profit after tax will change. Now if your debt equity ratio changes, your profitability changes, it also means that you may have a scenario where if you are given any, if you have any debt covenants under your debts, now in that case perhaps there may be a requirement to renegotiate your debt, those covenants with the lenders. Okay, so that's why what this, how the life will change is that you have to relook at your transactions, your structures, because Ind AS and IFRS they put so much of emphasis on substance rather than the form. Likewise, you will see as we adopt Ind AS, there will be a whole lot of increasing use of present value and fair value concepts. In the subsequent discussions in the slide, you will see that how, let's say for instance, when you are applying the business combination accounting, there's a whole lot of use of fair value. Likewise, when you have, let's say, you are issuing, the financial instruments, you may have the requirement to have to apply present value. Some of those things which we will discuss later today, and I have included a few examples, numeric examples also, so that we can look at how the present value computations would be done under Ind AS scenario. Likewise, you will have a lot of estimates and judgment. These Ind AS and IFRS focuses more on risk and reward. And if there is a prior period, there is an accounting error, that in Ind AS these require to be restated. If there are material prior period errors that has happened, which an entity is required to correct, in that scenario, the correction is done by way of restatement of the prior year financials. Again, there is a lot more emphasis on extensive and wide disclosure in the notes to the accounts. So a lot of disclosure requirements will kick in once we apply Ind AS. So these are some of the fundamental or big ticket changes one can expect under Ind AS. Moving on, as I initially mentioned, that we should look at what is the roadmap applicable for corporates for Ind AS implementation. So if you look at this slide, we had a phase-wise implementation schedule for Ind AS in respect to the Indian corporates. Now that phase-wise implementation, if you look at here, that is based on based on the net worth and also on whether or not that entity is listed. So if you look at in phase 1, as per phase 1, the Ind AS implementation was starting financial year 2016-17. So 1st April 2016 was the date when Ind AS was supposed to be applicable for phase 1 company. And when we say phase 1 company, it means essentially all listed companies with net worth of 500 crores or more are covered under phase 1. So any listed company which has net worth of 500 crore rupees or more will be compulsorily covered as part of phase 1 Ind AS implementation. And then apart from the listed company, all unlisted companies, as long as the net worth of those companies is 500 crores or more, is also covered under phase 1, which means whether listed or unlisted, as long as your net worth is 500 crore rupees or more, you are covered under phase 1 starting 16-17. And in phase 2, which is starting next year, which is 17-18, all listed companies, irrespective of the net worth threshold, were covered under phase 2. But when it comes to unlisted companies, the threshold was reduced from 500 crores to 250 crore rupees. So which means if you'll see that there is a lot more emphasis in terms of bringing more and more companies within the fold of Ind AS. Of course, 16, 17, 17 and 18, all of these periods are gone. So today, any time where what happens is once you meet this threshold, you apply Ind AS next year onwards. Okay. And one more important thing is that if a company or an entity is covered under the framework of Ind AS by meeting these threshold given in the roadmap, then in that case, all the entire group basically comes into the Ind AS fold, which means the holding company, subsidiary company, associate, joint venture, all of them, even if they do not meet the threshold, they are also covered, which means the entire group comes within the fold of Ind AS implementation. And once you started applying Ind AS, there is no rollback. It's a one-way traffic. The moment you are in this Ind AS implementation, later on, even if your net worth is dips, and let's say you are no longer within 500 crore turnover or 250 crore turnover, not turnover, 500 crore or 250 crore net worth threshold, even then, the fact of the matter is once you have implemented Ind AS, you cannot go back. You will continue to apply Ind AS even if your net worth later on dips because of, let's say, your sustained losses and because of which your net worth has come down. But then also, you will continue to apply Ind AS.
Could you highlight a little more on the first statement which is there is companies other than banking, insurance and NBFCs?
Yes. So the way
that's out for banking industry, because this kind of preference and reinstatement has a big impact on the net worth of the bank.
Yes. So couple of things. One is that, of course, those we will see when we will have the discussion on the financial instruments. But in terms of the roadmap, depending upon which is the type of entity, the roadmap is different. So, for instance, for banks, RBI has given its own roadmap, which is now, if you look at today, initially the plan was that the banks would be applying from 1890 Ind AS. But considering the preparedness of the banks in terms of implementation, now RBI has deferred the implementation by 1 more year, which means now Ind AS will be applicable for banks starting next year. Likewise, insurance regulatory authority IRDA, they have also come up with their plan, and that is again now deferred for 2 years because of the fact that there is globally a new standard covering insurance insurers is rolled out by IASB. That's called IFRS 17. Now, because of which we wanted to make sure that we go and synchronize our Ind AS implementation with that. So, yes, there are different roadmaps for NBFCs, but NBFCs, yes, they have already started implementing Ind AS from 1890 onwards. But we will see these in subsequent part of our discussion. So again, as I said here that we started 16-17 was phase 1. So just if you put it on a diagram, basically, if you see this piece is your first Ind AS financial statement for a phase 1 company. So 16-17 would be the first year. Now the comparative, the prior year would be your 15-16 would be the comparative period which you have to give in case of phase 1 company. And again, as you move along, if suppose 18-19 is your first year, then 17-18 would be your comparative period. Now, beginning of this comparative period is the date when you have to prepare your what is called opening balance sheet. Now, what is important to know is that this opening balance sheet has to be prepared by applying the accounting policies which are applicable at the end of this period. So, in this example or in this timeline, if you look at, though the opening balance sheet is required to be prepared on 1st April 2015, but this balance sheet is required to be prepared by applying the accounting policies which are applicable as of 31st March of 2017. Okay, so that's very important. Okay, so some of the significant impact areas which we are likely to see once we move on and apply Ind AS. If you look at this table, this chart, I think any area which comes to your mind, essentially it is getting impacted. Whether it is revenue, whether it is fair value, whether it is your business combination, consolidation, ESOP cost, stock-based compensation, leases. Everything is getting impacted. But what we would be doing now, financial instruments, not to forget, one of the biggest areas which will be impacted by this. So, as we go along, we will see some of these critical changes, how they are going to be impacting the industry. And pharma industry is part of. So the impact will be felt across all the industries, including pharma industry. So let's see. First, revenue recognition. So as I alluded to earlier, that we now have a new revenue recognition standard, Ind AS 115, which now starts, which is effective from 1st of April 2018, the current financial year. Now, what is important is this particular standard, it replaces all existing Ind AS related to revenue recognition. So we had multiple literature in the past. Okay, all of those literature have now been, they are now no longer applicable, and all have been replaced by a single cohesive literature, which is Ind AS 115. So this standard deals with revenue from contracts with customers. So whenever we are talking about how do we go about recognizing revenue in respect of a contract with customer, starting 1st April 2018, it is Ind AS 115. That is the only literature which is applicable. Now, this new framework, it focuses on performance obligations which you have committed in a contract, and how do you allocate the transaction price with respect to those performance obligations. I'll give you a very simple example. Today, let's say when you go and buy a motor vehicle, you go and buy a car. Now, when you buy a car, associated with when you buy the car, you will also get, let's say, 2 years or 3 years of free AMC. Now, it is called as a free AMC, but nothing is free in this world, right? So essentially, when you go and buy a new car, you are essentially buying two things. You're buying the car per se, as well as you are also buying AMC for whatever that period, 2 year, 3 year is applicable in this case. So what this standard says, that in a particular contract, in this example which I am giving, purchase of car, there are actually two performance obligations, not just one. You are not just buying car, you are also buying the AMC. So what this standard says that in those scenarios, look at whether you have multiple performance obligations under a contract. If yes, figure out what are those, and then total purchase, total transaction price applicable to that contract should be allocated to all of those performance obligations. We will see the methodology as we go along. This is just a preliminary slide. So I just wanted to introduce you to this fact that the focus of this new standard is basically to find out how many performance obligations you have in a contract, and then the transaction price needs to be allocated to those performance obligations, considering the mechanism provided in the standard. Okay. Another thing which is important to note, that this new revenue recognition standard is based on control model. So what happened in the past, whenever we were recognizing revenue, the basic question which we were to ask was that when is the risk and reward is getting transferred from the seller to the buyer. And depending upon the point in time when risk and reward is getting transferred, revenue was recognized. Of course, risk and reward still remains as an important parameter, but it is no longer the only criteria. So what this standard says, that the revenue should be recognized when the control is transferred of control of the goods or services is transferred from the seller to the buyer, and that is the point in time revenue should be recognized. And what is control? There are guidance in this standard. It says that when control is transferred, there are guidance both from the side of the seller as well as the buyer. I have included one slide on that. We will see as we go along, we will see when the control, or what are the indicators when we say that the control has been transferred from the seller to the buyer. So that is also important, that it is a control based model rather than a risk and reward model. Of course, as I said, risk and reward also remains as one of the parameters, one of the indicators which indicate when the control has been transferred. Okay, let's move on. So, as I mentioned, this standard that in March 2018, basically MCA notified, and these are just a couple of days before the year end, and this is applicable from 1st April. So what is the core principle? The core principle, if you see here, this is the core principle under the standard. What it says, and I'll go slightly slow to make you understand what it says. It says that recognize revenue to depict transfer of promised goods or services to the customers in an amount that reflects the consideration to which the entity expects to be entitled to. It does not say the entity is legally entitled to. It doesn't say so. The entity expects to be entitled to in exchange for those goods and services. So let's take a very simple example today. Now you are selling, let's say, your goods to your customers, and you say that depending upon how much quantum you take in a year, I can give you volume discount. Now, assume that 1,000 rupees is your, the price, normal price, but you have committed that if you buy X amount, X quantity, I'll give you 10% discount. Now, if the customer happens to achieve that target of the offtake, then in the example of 1,000 rupees, the price is actually 900, not 1,000. Because 10% discount is also involved. So that is why this standard says that you have to estimate how much is the discount which is likely to be passed on. So in this example, revenue should not be recognized as 100, assuming that you believe that the customer actually will be able to avail the discount, then your actual revenue should be restricted to 900, not 1,000. So this is what, see here, you will see a difference, because currently what we do, we would have accounted under the existing literature, we would have accounted for the discount at a subsequent point in time. Whereas here, the core principle it says, suggests when you are contemplating what is your revenue to be recognized, you consider all of these factors also. Okay, and if you see at the bottom here, what we are saying, as I mentioned, because it's a control-based model, this standard says that you should recognize revenue when the entity transfer controls. So, control may be transferred, as you know, control would be transferred at a point in time immediately, or it can be transferred over a period of time. So, depending upon whether the entity is transferring the control at a point in time or over a period of time, revenue should be recognized. So revenue should be recognized when the entity transfer control, or revenue should be recognized as the entity transfers control. So in over a period of time, as it passes on control, you should recognize revenue. We will see in yes.
Suppose in this example, out of 1,000 bucks, you recognize 900 rupees.
Yes.
Because you anticipate 100 rupees of discount you
Correct.
offer later.
Correct.
So your revenue and P&L profitability for the company for that year,
Yeah.
say year one,
Yes.
is 900 rupees.
Yes.
So profit is lower to the extent of 100 rupees.
Yes.
Now after 2 years,
Yes.
you offer, or next year you offer the discount actually.
Mm-hmm.
So does that mean that your discount is going to hit your P&L again, reducing your profitability for the next year?
No, it is not. So the thing is that when you give discount, essentially you should have recognized 900, which you have recognized in year one.
Right.
Now your question should be slightly different in my mind. That what happens if 100 was not actually availed, but what was availed was 90 or 120. So what happens that the standard says, yes, that true up or true down you can do in the period when you actually pass on the discount. But in real sense, you estimated that it is the 100 rupee discount you will be giving, that you should account in the year when you are actually doing the sale. But to the extent of true up or true down, you can do it in a later period. Okay. So continuing on this slide, so we have seen what is the core principle. Now to achieve this core principle, there is a 5-step model which have been prescribed under this particular standard. What it says, the first thing first is you identify whether there is a contract with the customer within the meaning given in this standard. And if there is no contract within the meaning defined, if that contract does not exist within the meaning in this particular standard, don't recognize revenue. You wait till the time you have a contract, so that there will be a deferral of revenue recognition. Secondly, then identify performance of obligation. I gave an example of car and AMC. So identify what is the performance obligation in the contract. Then determine the transaction price, how much price you are paying. Now, this determination of transaction price when you have a fixed price is relatively straightforward thing. But where in situations where when there are variable pricing involved in the contract, it may become slightly challenging. For instance, if you have variable considerations in terms of, say, performance bonuses, or we talked about the discount, rebates. Now in those cases, it can be slightly challenging because you have to estimate, and then based on how the actual is vis-a-vis the estimate, you have to do the true up or true down at a subsequent period of time. The fourth step is that once you have determined how much is your total transaction price, then that transaction price needs to be allocated to all the performance obligations which you identified in step 2 above. Okay? And then the revenue should be recognized, as we discussed there, as the entity performs its obligations, or when the entity performs its obligations. We'll see one by one, each one of them. So if you see here, step 1, when would you say that the contract actually exists with the customer? It says the contract exists with the customer only when it is legally enforceable in a court of law, and there are other few conditions. That it is approved by the parties and the parties are committed to their respective obligations. Then the right to goods or service and payment terms can be clearly identified in the contract. The contract should have commercial substance, and the collection under the contract, so collection of the consideration is considered probable. Okay, all of these conditions must be met, then only you have a contract within the meaning of this standard, and the contract need not be written. It can be oral also. I mean, in fact, our Indian Contracts Act also allow you to have an oral contract. It is possible, but it is always advisable to reduce your contractual terms in a written agreement. But as far as this standard is concerned, the contract need not be in writing. But then, as to get to the fact that you have the contract with a customer or not, all of these must be met. All of these features must be there in a contract. Then only it can be stated that yes, the contract exists within the meaning of this particular contract, with this standard. Moving on to step 2. So first, yes, contract exists. Now we have to identify what are the performance obligations under the contract. Now to this, first of all, what is performance obligation? A performance obligation can either be explicit or an implicit promise in the contract to transfer goods or service or both to the customer. Right? So, this standard also says that you have to look at your contractual terms and customary business practice to decide what are the performance obligations, and whether there are multiple performance obligations or not. For that, you have to apply these 2 tests. Okay? And before we can get into this slide, but let's take a very simple example. Now, today when you go and buy a mobile phone, which is a GSM phone, GSM compatible phone, what happens? Isn't that phone capable of being used independently, with or without the use of other resources? So you need a SIM card, right? SIM card could be for Airtel, could be Vodafone, or anybody, right? As the mobile phone per se has its utility, it is capable of being used independently or along with some other readily available resources. But we also have to look at whether that in this contract, whether can it be used in the context of the entire agreement. Can it be used? So for instance, assume that this happens to be a CDMA phone. Then in that case, if it's a CDMA phone, you cannot put somebody else's SIM and use it. So there are 2 criteria to decide whether you have a multiple performance obligation or a single performance obligation. You have to look at these 2 criteria, whether it is capable of being distinct, and whether it is distinct within the context of the contract. Okay? So, and if the answer is yes, both of the condition is and. If the answer is yes, both these are met, that's a distinct performance obligation, else it is not. There is an exception also here at the bottom. If you see, what this standard says that sometimes there may be a series of goods or services that are being transferred, which are substantially of the same nature, right? And have the same pattern of being transfer, but they will still be considered as a single performance obligation. Simple example. Let's say if you have a cleaning service contract, wherein an agency deputes certain personnel to say clean the floor, wipe the floor. Now, this contract could be for 2 years or 3 years, right? Technically, one can argue that every day this step is being done of cleaning and wiping, right? So, is it a performance? Is it a multiple performance, agreement or a single performance agreement? So, the exception says that in these cases, it will be a single performance agreement. Or we have a single performance obligation in this contract. We'll see further with more examples. So if you see here, now this is an example of you have a single performance obligation. So if I say for instance, you go to a builder and you say, construct my house. Now, in the process of constructing the house, the builder may acquire the inputs, may buy all these inputs. You may buy bricks, you may buy cement, you may buy the window panels and all of that, right? And then he will do integration of all of these and give you a house. So the question what we have to ask is that if you ask a simple question, can you benefit out of cement? Can you benefit out of steel? Answer is yes. Same question which I explained with the help of mobile phone example. Yes, the criteria one is met. They are independently useful. But then here the builder is giving you a lot of integration services, because you are not going to him to buy cement, steel or window. You are going and buying a house. So the builder is integrating and giving a lot of integrated activities. So in this case, considering the context of the transaction, this second criteria is not met, and because of this, all of these are a single performance obligation. They are not multiple performance. Single performance obligation of constructing a house. But let's see another example. This is an example of how do you differentiate single performance obligation versus multiple performance obligation. Now here, assume that you buy a Xerox machine, and the seller tells you that okay, I will also do a standard installation in your premises. Now the question is whether the machine or the installation services are they a single performance obligation or multiple performance obligation. Now to this, the criteria always remains the same. These two criteria you have to apply. Yes, both are important. But here, assuming in this example, it is assumed that this installation service is not something which is very unique. It's a standard installation service, which can be potentially be done by any third-party vendor also. You can have some your nearby mechanic, and he can also do this installation. So in this case, there are two different performance obligations, because criteria 2 is being met. There is no significant integration services being done by the provider of machine. So that's how you will differentiate whether integration services have been provided, whether there is a significant integration. If yes, in the prior case, you are buying a house, not the independent inputs. Likewise, but in this case, since you have standard installation possible, integration of services is missing, and in that case, because of this, you will have multiple performance obligations. Let's see an example applicable to pharma industry, for instance, or multiple performance obligation. So let's say if CD Corp is a pharma company which entered into an agreement with a customer, let's say Patnam. Under the agreement, the customer gets a license for exclusive right of a compound called G. And CD Corp undertakes to perform the R&D services to get the compound G approved for commercial sale. The CD Corp also undertakes the testing and validation of the efficacy of the compound G. However, the R&D services required to develop compound G can potentially be performed by any other pharma company in the industry. Similar to what we saw in case of installation. So this is not a unique, not an integrated service. Okay. So in this case, what will happen? So because of this, you have distinct performance obligations similar to what we have seen in case of, because there is no significant integration, just like in the prior case here, R&D services is a separate component. There are multiple performance obligations. Licensing and R&D are two different pieces, two different performance obligations in this example. Okay, so moving on to step 3. So the step 1 we saw whether there is a contract. Step 2 we saw what are the performance obligations. Next is what is the determine what is your transaction price. Now, as I already told you, transaction price is a fixed price. It's relatively simple. Whatever is the fixed price, that's your transaction price. But then, if you have a variable consideration, that could be in the nature of all of these, can be discount, credits, incentive. Let's say, in case of a construction contract, you may have a scenario where you will say, if you complete the construction in next 6 months, I'll give you 2% incentive. But if you do it in 1 year, you will get 1% incentive. Beyond 1 year, no incentive. So there is a variability in the transaction price from the perspective of the service provider. Now in that case, what the service provider estimates when he will be able to complete that contract, accordingly he has to estimate the transaction price. So that's why in situations where the transaction price has variable consideration, all of those variable considerations also have to be considered. But also what is important, there is something called constraining. So whatever you estimate, you should be slightly conservative. The reason, the overarching objective is that you should consider your variable consideration in such a way that later on it should not lead to significant revenue reversal. So you be conservative, estimate it on a conservative basis with the overarching objective is that you should do it in such a way that subsequently in future period it should not lead to revenue reversal. That's the requirement. And when you are estimating the variable consideration, there are two techniques or two methods which are available. One is called expected value method, another is called most likely amount or most likely method. When you apply the expected value method, when you have multiple categories of or possibilities of outcomes which are there and each one have a multiple probability, then in that scenario you would use expected value method. But when there is a question of only single outcome possible, either you will say you will be able to achieve or not able to achieve. In that case, you will apply the most likely method. And again, constraining or capping, as I said, that will apply in any case, because you do not want to see a scenario wherein you estimate something aggressively and later on you have a scenario where you have to reverse your recognized revenue. Okay? Continuing on the transaction price, one more very important concept is that sometimes the arrangement which you have entered into with the customer would be such wherein it involves significant financing component. For instance, you get into a contract with the customer saying that, okay, you supply me the goods or service now, I will pay you after 3 years. Or you pay me now, I will supply you the goods after 3 years. Arrangement can be worked out, it's a commercial contract. Commercially, you can agree. What this standard says that if there is a, so technically, let's say if you are giving 6 months credit to others, but in the arrangement you have got, you say after 3 years I will pay. Now, which means essentially if you are deferring your payment, the other side is giving you a financing arrangement. So that's why this standard says that if you have significant financing component, you carve out what is the amount or what portion of the transaction price relates to this kind of a the significant financing component which is inbuilt in this contract, carve that out. So assume if your transaction price is 100 and the significant financing component comes out to be 10, then your actual transaction price is 90. 10 is your interest cost or interest income, depending upon whether you give an advance or you are deferred repayment. So if you see here in this chart, let's say you are performing your goods, your obligation at this point in time, t is equal to 0. What is the standard says? Up to 1 year, okay, we'll give you the benefit of doubt. 1 year this side or that side, that's fine. No finance, you don't have to adjust your transaction price. But if this is a practical expedient given under the standard. But then, if it is more than 1 year, either side, then in that case, depending upon whether you are giving, the financing or whether you are taking the financing, you will have interest cost or interest income. Yes.
Here's the question.
Yeah.
Why we recognize revenue in such strict norms?
Mm-hmm.
The P&L is a composite of purchase and sales, both sides.
Right.
On the purchase side are similar standards.
Yes, it is same. Yeah, exactly. So let's say the inventory also IAS 2 or India corresponding standard Ind AS 2, then also exactly the same thing is there. That if you buy inventory with this kind of a significant, yes, you have to carve out that portion. Okay, continuing on determining of the transaction price. Now, sometimes it may happen that you discharge your obligation, not by way of a cash, but by way of a non-cash items. So let's say you issue your shares. So the question is, how do you calculate the transaction price? So if you see at the bottom, it says, in case you have given the non-cash consideration, like an equity instrument, that should be measured at fair value of the consideration received or promised and is included in the transaction price. So essentially what it says that you have, again, it brings me back to the previous conversation where I said that these standards have a lot to use, many times they will be we will be using the fair value concept and present value concept. This is one example here where we will be using the fair value concept, right? So essentially in step 3 what we are doing, we are trying to assess what is your total transaction price, because what is the objective? The objective is that the total transaction price which we have got needs to be allocated back to the performance obligations or multiple performance obligations if you have. So if you have 5 performance obligations and your transaction price is 500, then depending upon what is the relative or standalone price of each of those 5 performance obligation, you allocate the transaction price. We will see that in the next step. But what step 3 says, you determine what is your transaction price. Now next step would be allocation. So you have a contract, you know what your performance obligations are, you know what is your transaction price. Now the question is, how do you allocate it? So the total amount of or total transaction price is allocated generally by applying this. So the requirement is determine the standalone selling price. So let's take an example. Continue the example of the car and the AMC. Okay. Let's keep the number simple for your easy computation. Let's say the car and AMC together is sold for 100 rupees. Okay. Now that same supplier is also giving you an option. If you do not want to buy an AMC, just buy a car. Okay, I will sell you at 90 rupees. Or it also gives you that you can buy only AMC. Let's say for an old car, you can buy AMC at 30 rupees for the same period. So 90 plus 30, 120 rupees. But what the combo of the car and AMC is given at 100 rupees. So what essentially it says that 100 rupees is the total transaction price in the ratio of 90 divided by 120, 30 divided by 120, you should allocate the transaction price. So relating standalone selling price in the example which I gave, 90 rupees and 30 rupees. So 90 plus 30, 120. So 90 divided by 120, 30 divided by 120, that is the ratio which you apply to the transaction price for both the combined obligation. We will see with an example also. So what is allocation? For allocating, the entity need to decide what is the standalone selling price. In my example, I gave 90 and 30, and then allocate that the transaction price to performance obligation using that standalone selling price. Okay. And what is the evidence? Best evidence of a standalone selling price? It's observable price. So which means, in the example which I gave, if the entity itself has that scenario where it is selling car on a standalone basis without AMC, and they are selling AMC without the car, that's the best evidence of what should be the standalone selling price. So let's see one, here. So this is the mechanism. But what happens? Suppose the observable price here, we in the previous slide, we have gone with the assumption that observable selling price is available. But what if it is not available? Then the standard gives you these three possible, options or approaches that you need to follow. Okay. So if that is not there, you apply adjusted market price or market assessment approach. In this approach, you will evaluate, what is the market for that particular goods or service. These goods and services are being sold, and then estimate the price that the customer in the market will be willing to pay. So instead of 90 and 30 from the entity, you have to estimate what the customer will be willing to pay, and that is the ratio you apply. Alternatively, second approach is called expected cost plus margin. So in this case, you forecast the expected cost of satisfying the performance obligation. So cost of supplying the car, cost of supplying or providing the AMC, and these two, on that cost, apply a suitable appropriate markup. That is the ratio which you apply. And the last is the residual approach, which is used only in a very limited circumstances. If you are not able to apply the other three approaches, which is observable data or adjusted market assessment approach or the expected cost plus margin approach, if you are not able to apply, then only you will apply the residual approach, where you will determine the total transaction price, and from there you will subtract the sum total of all the other observable selling price. So it's like a residual. Total minus what you can estimate, balance is the residual. Let's see with an example. Okay. So let's see here, you have a scenario where it is similar to what I said, 90 rupees, 30 rupees, where the entity is selling separately also, combo offer also. Here if you see, the entity is selling phone as well as the data plan. Now, the combo, if you take the phone plus a 2-year data plan, they are offered at a price of 650 rupees. But if you take them independently, phone itself will cost you 350 and 2-year data will cost you 360 rupees. So together if you buy independently, you have 710 rupees is the total payout. But if you buy combo, you are only paying 650. So 710 minus 650, 60 rupees is an implicit discount embedded in a combo deal. So how do you do the allocation? Again, as we discussed, standalone selling price. In this example, standalone selling price would be 350 and 360. So here, if you see the computation I have given, the 650 rupees of the transaction price, you will allocate in the ratio of 350 by 710 and 360 by 710. Clear? And if that is not possible, then you apply the other methods which we discussed in the previous slide. Adjusted market price, cost plus or residual method.
So in the residual method,
yes,
any warranty obligation should be reduced?
Again, so the thing is that if you see here, what does it say? Total transaction price minus all the performance obligations which you have. For those performance obligations, subtract so let's say you got 5 obligations. So for 5 out of 5, 4 you were able to have the price, standalone price. The 5th one, let's say, is warranty, right? So of the total you reduce 4, 5th becomes the residual, and then in that ratio you then apply the.
So warranty is for expired goods. So after 2 years I am getting the products back if it is not sold for him?
Sorry, I'm not getting what you said. Can you repeat what
In
you
pharma industry, for
Yes.
example, expired goods will be generally taken back by the manufacturer.
Okay.
So should you reduce for that obligation?
Now, so if you are contractually bound to get the, if you have contractually agreed that you would be taking those things back, then in case of your revenue recognition itself, you should have estimated how much you will be getting a return, which is not your revenue.
So should it be reduced from my
Revenue itself, you will be deferring, you will defer the revenue till the time. So let's say you will estimated that 10% of the goods will be returned back. So you will recognize 90%, and once there may be a period, 2 years, 3 years, whatever. Once that period expires, and assume that 10% were not returned, then you recognize that 10% revenue of
So
that.
it will not form part of my indirect expenses. It should be reduced from revenue.
It's a revenue itself, yes, it's part of revenue itself, correct. So basically, because of based on your contractual arrangement, you are estimating that part of the things will be returned back to you, which is not your revenue. So you would defer it till that time, and if the time expires, and if it has not actually been returned, then you recognize at that point. It's like true up or true down, which we talked about. Okay. Now, so in step 4, what we have done, we have allocated. Now, the step 5 deals with when to recognize, timing of revenue recognition, when to recognize. At a point in time or over a period of time. Now, as I mentioned in the beginning, there are indicators of when the control, the hallmark or the basic requirement is when control is transferred, recognize. Now, that you recognize revenue either at a point in time or as over a period of time. So when control is transferred, this is the guidance given, that there can be these indicators from a customer side, whether the customer has a legal title to the asset, and all of these are not cumulative, which means not all must be satisfied in a particular case. These are all the indicators, all of them you have to look at, but all need not be satisfied. Let's say 3 out of 5 is satisfied, 4 out of 5 is satisfied, basis which you should decide. So whether from a customer side, whether the customer has a legal title to the asset, whether the customer has taken physical possession of the asset, or whether the customer has accepted the asset. Whereas on the other side, from an entity side, supplier side, whether that supplier or the entity has a present right to payment, or whether the supplier has transferred significant risk and reward. So here you will see risk and reward is one of the indicators of control, whereas there are other factors also. And accordingly, you will decide whether, and depending upon when the control is transferred, you will recognize revenue at a point in time or over a period of time. So let's see here. This flow chart tells you when you should apply over a period of time and when you should apply at a point in time. So the way it is structured, normally you will start with that the revenue should be recognized over a period of time. And if those conditions are not met, then only point in time. So if you look at the top section here, first 3 points, these are the cases, these are the questions which you have to ask, and if the answers to these questions is yes, you apply revenue recognition over time. But so we'll see each one of them. The first thing, and again, this is again any one of these 3 questions. Anyone if it is satisfied, you will recognize revenue over a period of time. First question, whether customer simultaneously receives and consumes the benefit provided by entity's performance. So same example we gave a cleaning services. Now cleaning services, as cleaning is performed, services are consumed. So if the answer is yes, you will recognize revenue over a period of time. Right? But if the answer is no, ask next question. That whether the entity's performance creates or enhances an asset that the customer controls as the asset is created. So let's say you have given on your land, you have given your own land, you have given a construction of your house, you have given that assignment to a vendor. Now the question is, do you control that as the construction is completed? Do you have the right? So if tomorrow you are not happy with the services of the builder, can you kick him out and control whatever he has completed, and rest you will be able to get it completed by some other builder? If that answer is yes, over period of time. If no, ask next question. Entity's performance does not create an asset with an alternate use to the entity, and the entity has an info. So what I am creating for the customer, it is a very specific asset. I cannot use it for my own purpose. I do not have any alternative use. I am developing and creating it only for that particular customer. If that is the answer is to that is yes, recognize revenue over period of time. And if answer to all of these is no, then you apply revenue or recognize revenue at a point in time. And these parameters is the same which we saw in the previous slide, which means these are the indicators of control, all of these fives. This is what is reproduced here. So essentially, you will start with the premise you should recognize revenue over a period of time in these three conditions, and if these are not met, then at a point in time. Fair enough? You can move on. Okay. Now another important area which this standard considers is how do you do the accounting for licenses. Okay. So sometimes it may happen that license is embedded in transfer of other goods and services, or license could be a standalone performance obligation. Okay. Now the license also can be of two types: right to use or right to access the license. So if you see this table here, this chart here, it says when you have the right to access the IP or when you have the right to use the IP. So if you look at these three criteria, if all the three criteria is met, then you have a right to access the entity's IP, and if all three are not met, then you have the right to use the IP. So the guidance in this standard is this. If you see this flow chart, it says if your license is embedded in some other goods and services which is a single performance obligation, then you apply that five-step process which we saw, so there is a single performance obligation. But then, so this is what it says, is the license distinct? If the license is distinct, then only you will go and get down here. If the license is not distinct, you apply the general guidance which we saw so far. But if the license is a separate performance obligation, then you ask these questions. That does the customer have the right to use the entity's IP or right to access? Depending upon whether you have the, so here, if you have the right to use, then in that case you will recognize the revenue point in time. But if you have the customer has the right to use the IP, you will use, if he will use a point in time, but if he does not have, then over period of time. So as far as the license is concerned, this is a special guidance given. In the sense that if it is embedded, apply the general guidance. But if it is not embedded, if it is a separate performance obligation, depending upon whether it is right to use or right to access. If it is right to use, point in time, right to access over a period of time is what you should recognize. Okay? Next, very important that this standard also gives you a guidance on whether you are an agent or a principal, because it is only the principal which can recognize revenue gross. If you are an agent, you will recognize revenue net, which means only, let's say, to the extent of your remuneration. The grossing of revenue you will not do. So this slide tells you that when one is to be considered as an agent, one needs to be considered as a principal. So if you see here that overview chart, it says you have to identify the goods and services to be transferred. First of all, you identify what goods or services are to be transferred to the customer, and Then the next question, so let's say you say, okay, this goods needs to be transferred. For simplicity, let's say only one good needs to be transferred to the customer. The next question you need to ask, do you control that goods or service before it is transferred? So before it is transferred to the eventual customer, do I control what needs to be transferred? If the answer is yes, I am the principal. If the answer is no, I am not the principal but an agent. Because if I do not control what needs to be transferred to the customer, I am only acting on behalf of somebody or under direction of somebody. I do not control what is going to be transferred to the customer. Let's see this in a slightly greater detail. This concept, this is a more detailed flowchart. What happens? First of all, if there are only two parties, buyer and the seller, there is no question of agent, right? So that's why the first one, if you see, is a third party involved. If there is a third party, then only there is a question of agent or principal arises. Otherwise, if there are only two parties, I have to be the principal and the other party has to be a customer. So, is the third party involved in providing? If the answer is no, then the principal agent guidance doesn't apply. If the answer is yes, ask next question. What identify the goods and services? Let's say cement has to be transferred. Okay. So identify goods and services to be provided. Okay. Cement has to be provided to the customer. Next question. Does the entity control the specified goods and services before it? So do I control what cement I need to transfer? If I do not control, I am not a principal. But if I control what need to go, I can tell my agent, provide supply this. So the person who is supplying, he is not controlling, he is not deciding, he is only telling, or he is only executing what I am telling him to do. So the person who is executing is an agent, the person who controls this decision is the principal. So does the entity control the specified goods or service before it is transferred to the customer? If the answer is no, then he is an agent. If the answer is yes, he is a principal. So if it is a principal, he will recognize revenue gross, and if it's an agent, he will recognize revenue net. Net, when you say net, which means only restricted to the consideration or the compensation as an agent he is entitled to receive. Fair enough? So we will now conclude our conversation on this particular standard. What I have done in this slide, in next few slides, I have just kind of collated some of the key considerations which we already discussed, in our prior conversation. For each step, what are the things, as well as what are the key considerations for against each of those steps one need to really look at when we are implementing this standard. So, what are the practical issues? What are the implementation issues for against each of these steps, 5-step model? This slide and the next slide I have captured. Most of it we have already covered. So this is just a laundry list of all of those things you can go through. This presentation has already been shared with the institute. Hopefully you will be able to get it. Okay. And again, as I mentioned in the beginning, that Ind AS and IFRS, they have a lot more emphasis on expanded and extensive disclosure, and this standard is no different from that. This standard requires a huge amount of disclosure, whether it's a disaggregation of revenue, what judgments you have made for recognizing revenue, and what are the performance obligations you have, how have you concluded. There's a whole lot of discussions and the disclosures which are required to be given in the financial statements under this standard. So another significant area which is, which we should be aware, financial instruments, and this is a real, area where you will have a very, very substantial differences compared to what we have seen in the Indian GAAP. I gave one classic example of compulsory redeemable preference shares, right? Let's take some other example. Today, we have a scenario where, say, our factory office or our office building may be, let's say, on rent. So normally all of these rental agreement will have a requirement that you give some security deposit to the landlord. Now today what do we do? When you give the security deposit, what is the accounting entry we pass? What we record? Security deposit in balance sheet as a receivable, credit bank. Is that no longer? So what this financial instruments standard says that assume that this is a 10-year non-cancellable contract. After 10 years, assume you will be vacating the office and you actually vacate also. The security deposit in this example is a refundable security deposit you will get back. That you will get that amount back from the landlord. But you have given the security deposit today and 10 years down the line you will get, is it the same worth? No. Money has time value of money. So because of that, and again, typically you will see in these structuring that a tenant which gives relatively more security deposit, the rent can be low, and vice versa. So if you pay more security deposit, pay less rent, or vice versa. So that's why this standard says that in a scenario where you have given a deposit today which you will get after 10 years, you discount that security deposit to today's value. So what is the present value of that, assuming 10 lakh rupees you have given, that what is the present value of that 10 lakh rupees which you have given to the landlord, which you will receive back after 10 years for the rate of interest or discount, applicable discount rate, discount that. Assume that happens to be 7 lakh rupees. So the accounting entry today is that you have to record security deposit only 7 lakhs. What is the balance? 3 lakh. So the entry, security deposit 7 lakh, bank 10 lakh. What is the other debit of 3 lakh? The other debit is actually in the nature of a prepaid rent. So what it says, the entry you record is deposit, security deposit 7 lakh, prepaid rent 3 lakhs, bank 10 lakhs. Now what is this prepaid rent? This prepaid rent you have to amortize over the lease period. In this example, 10 years. So that you nullify that. Now another aspect. You are saying in my books, security deposit only 7 lakhs. But what you will get back at the end of 10 years is 10 lakhs. So when you get that money 10 lakhs, bank debit 10 lakhs, security deposit 7 lakhs, where is the balance credit? 3 lakhs. Where would you record? So this standard says, it is actually in the nature of interest income which you are getting. So two things. One is to the extent of 3 lakhs, you have a prepaid rent. But on top of that, you also have an interest income of 3 lakh rupees over 10-year period of time. So you will recognize your interest income in such a way that the 7 lakh become 10 lakhs in 10-year period, and then you knock off the 10 lakh at the end of 10 years. I have included a numeric example, but I just wanted to introduce you to this concept that how accounting of financial instruments is likely to undergo a significant change. I'll go through the example, but this is just to tell you how significantly the accounting will change. So let's see financial instruments. We'll go back to that example. Let us first see how Ind AS 9, which is the corresponding literature of IFRS 9, how it classifies financial instruments. Let's first see this. It's slightly busy chart, but read it the way I am reading. It's very easy. Okay, but let me just read it and you read it that way. First thing first, financial instrument can either be debt, equity or derivative. So, simple thing first, let's say it's a derivative. If you see at the bottom, first let me cover this and then we'll go back to, So if you see here at the bottom, it says FVTPL. It means fair value through profit or loss, which means that any changes to the fair value will be routed to profit loss account. If you see the other side, FBTOCI, fair value through OCI. So any change in the fair value will be routed to OCI. Okay, this is the nomenclature. Let's go back to the requirement of classification. What it says, if you have a derivative essentially is for trading purposes. So all derivatives must be fair value. By the very nature, you are hedging your positions, right? So all gains and losses with respect to derivatives go to profit loss account. So that will go to P&L. Straight simple thing. If you have a derivative, any gain or loss on derivative, straight goes to P&L, whether it's a gain or a loss. When it comes to equity, you have to ask one question. Actually, two questions you have to ask. First question you have to ask is the equity instrument you are holding for trading, are you trying to make profit or loss, gain or loss by holding that? If the market price goes up, I'll sell. So if that is what you are trying to do, if the answer is yes, equity is held for trading, that is the purpose with which you hold, was to buy and sell, then gain or loss goes to profit loss. So if this is held for trading, fair value changes goes to profit loss. But if you are not holding for trading, one more question you have to ask. This question is, has the entity, like I can say, okay, I am not holding for trading, but I do not want my profit and loss account to be impacted by the movement in the value of security. So what do? I have an option under the standard. I can choose to say, okay, I do not want to get this movement into P&L. Let me route it through OCI, other comprehensive income, permitted. But then this permission is irrevocable. Once you have chosen, it's lifelong. For that instrument. For if you have bought 5 securities, you may say 3 I will be using for trading purposes. Fair value will go to P&L. 2 I do not want to use for trading purpose, for which you have given an option, irrevocable choice at each instrument level till the time the instrument exists. Fair value change will be in OCI, not in P&L, permitted. But then, even if you sell that instrument later, the cumulative gain or loss on account of those 2 instruments will directly go to general reserve from OCI. It will never come to P&L. And that's very logical, because you yourself said that you do not want profit and loss to be impacted by those movements. Fair enough, you have been given that option, don't do it, but then you cannot take the benefit also at the end. So that's why you see here, no recycling. No recycling means, even if you sell that asset later, the equity instrument later, it will not be recycled to P&L. It will recycle back to the
How does this work along with MAT?
No, so
That will become a crisis.
certainly tax we are not talking. Tax will have its own consequences. We are only talking about accounting at this point in time.
This part and part, looking at the elephant becomes very dangerous.
Yes, sir. That is correct. The point is, see, if you ask me today, we have ICDS, we have Indian GAAP standard, we have Ind AS. All talk different language. So that's the challenge which we have as a professional, that we'll have to live with unless and until we have a same set of standard. Obviously those challenges we have to face. But again, so let's come back to, we can take this offline if required. Okay. Yeah. But unfortunately that's how the standard is, and we have our tax laws, we have to honor our tax laws as well. Unfortunately that's what the challenge is. Right. Okay. So going back. So here, now it is clear how do we do derivative and equity. Okay. The complicated part is this debt. Okay. So what it says for when it comes to debt, classification of debt instrument, again 2 questions you have to ask. First thing, why you are holding that debt instrument? 2 things. What are the cash flows associated with that instrument? Is it solely payment of principal and interest? For let's say a debenture or a bond, it will give you principal, repayment and interest. Okay. So if that is not the case, it is not a debt in the true sense. And if the cash flows of a debt instrument are not solely payment of principal and interest, then it will again move to fair value through P&L. Okay. So okay, we'll come back to that. So first 2 questions. First, what are the cash flows? Is the cash flow solely payment of principal and interest? And what is the business model? Why you are holding the debt instruments? So let's say you are holding the debt instrument to hold the contractual cash flows. So let's say an FMP, fixed maturity plan. What do? FMP you are holding, you can't sell it. You are holding till the maturity the money, and at maturity you will get the cash flow. So you are holding that for contractual cash, collecting the contractual cash flows. But sometimes it may happen You do not know whether you are holding for collection of the cash flows till maturity, or if there is a requirement, you may have to sell also. So that is the second one. Hold to collect and sell if there is a requirement. And the third is, you are holding itself for selling. So the standard differentiates in this way, that if you have a debt which has contractual cash flow which is solely principal of payment and interest, then answer is, then you look at and ask this question, what is your business model? Depending upon what is your business model, you classify. If your business model is hold to collect, apply amortized cost. It is nothing but your debt amortization schedule. Debt amortization schedule.
Now let's assume that I have an investment in ILFS debt.
Yes.
Now it is standard, it would have fallen into one of the three categories, but now we don't.
So that those exceptional situations are allowed. That is an exception. So this is a usual scenario that in that. Yeah, so in those exceptional situations, it is allowed that you will have to move out, perhaps.
You will have to.
Yes, you have to move out. Yes. Okay, now if you see here, the difference is that here, this will, if you are holding to collect, you will apply amortized cost. If you are holding to sell, you will apply logically fair value through P&L. This is the in between. So you are holding to collect, but you may sell also if there is a requirement. Then, like equity, you can park this movement into fair value through OCI. But there is a difference between this and this. The difference is that when it comes to debt, you are allowed to recycle. So when you sell the debt or liquidate the debt, or you are exiting out of the debt, at that point in time, whatever is lying in the OCI, cumulative balance, you can move it to P&L. So that's why it is recycling. So what will happen, the net result of all of this is, how do you go about doing the measurement? Okay, so we saw in this previous slide, these are the categories of eventual measurement categories. So if this measurement category, if you look at, I have put at the top here. So what will happen? For, if you see the first three ones, the last three, fair value. As the name suggests, fair value, all fair value movement in these cases will go to, so for instance if you see here, fair value through P&L, everything in fair value changes will go to P&L. But when it comes to fair value through OCI equity, fair value changes will go to OCI, but let's say the dividend if it is declared on the equity, that will go to P&L. Only because what you are saying, fair value through OCI. So the fair value changes only will go to OCI, but if the dividend is declared, that's your P&L income. But when it comes to debt, same way here, fair value changes will be in OCI, but all the other changes, whether just like a dividend, if you have interest income and all, impairment, losses, everything will be routed through P&L. So what it tells you that depending upon which category you are, that's how you will be, measuring your financial instruments. We'll see with an example. Okay, let's see this. I alluded to this. Let's see. So what happens in this case? If you see the left-hand side, CT Corp has lent 10 lakh to ABSPL. The loan is repayable in full after a period of 5 years, and the loan carries interest at a rate of 5% payable annually, even though market interest rate is 8%. Why somebody is doing charity? If the market is 8%, why you are giving, only 5%? So next sentence gives you the answer to that. Why it is 5%? It says to compensate CT Corp for the below market rate, ABSPL pays origination fee of 1,20,000. So it is something like the same thing. More security deposit, less rental. Less security deposit, more rental. Same concept here. I am giving there's a 8% market interest rate. I'll pay you 5%, but to compensate the differential, I am giving you upfront 1,20,000 as your origination fee. What this standard says? Look at the substance. What are you doing? You are trying to compensate the lower interest rate by giving the origination fee. Correct? So how will you go about doing it? So in this scenario, how do you measure the financial assistance liability? Here, what if you see this IRR competition? Essentially what is happening, 10 lakh is the loan, but at the same time you are getting 120 as your origination fee. So net flows associated at time is equal to 0 is 880. This 880. This 880 is nothing. This 880, it is nothing but 10 lakh minus 120. And contractually, you are supposed to receive 5% coupon and 10 lakh at the end of the 5-year term as a repayment. You are plotting the cash flows here. Effectively 880, 50,000 in each of these years as your interest, and the 5th year interest of 50,000, repayment of 10 lakh. If you look at plot this simple financial instruments or financial management theory, given this cash flows, calculate IRR. IRR in this case turns out to be 8.01%. If you see here, 8.01%. So, in this scenario, legally the contractual coupon rate is 5%, but the accounting will be at 8.01%, not 5%, which is the substance. That's how really the transaction is. Just because you have structured a deal should not change the answer. So, an entity which raises a loan at the 8% versus an entity who raises a loan at 5% with origination fee should be at the same footing. That's the essence of this, which is logical. Just because of structuring, you cannot change your P&L, is what it tries to achieve. So what will happen here? Go to the second table, that side, right hand side. So now, from a debt amortization schedule perspective, 880 is your opening balance. Now that on that opening balance, you will be applying interest cost at the rate of 8.01% of effective rate, not 5% contractual rate. But of course, contractually you will pay only 50. So the cash payout will be 50. But then over a 5-year period of time, it will nullify. At the end, it will become 0. But then, in terms of your interest recognition, your interest in year 1 will be 70,452 and not 5% of 10 lakh. And that's how you will recognize your interest cost. So you can see there is a huge amount of change in terms of how we do the accounting. We are all okay with this? Let's see another one. This is one security deposit I spoke about. Let's see how the calculation works. I told if you are given 10 lakh security deposit, 7 lakh is your discounted value, 3 lakh is your prepaid rent. This is what concept we will see here. So if you see here, at the top here, we are given some key inputs with respect to this example. It says that you have provided a security deposit on 1st of April 2012. It's a 5-year lease, so the date of repayment of security, you will get back the security from the landlord on 31st March 2017. 5-year lease period, you have given 10 lakh of security deposit, discount rate assumed to be 12%. Now, if you apply this PV factor is simple, basically for 5-year at 12%, 5-year rate, PV factor is 0.56 or 57. So that 10 lakh into the PV factor will give you 10 lakh face value into the PV factor will give you what is the present value of the security at the beginning. So the security face value of 10 lakh, which you will get back after 5 years, interest rate 12% for discounting, that has a present value of 5,67,000. So the 10 lakh minus 567 is similar to 10 lakh minus 3, which I gave the example. Balance is the prepaid rent. So the same principle which we applied in the previous example, here it is, we have to apply the same principle for developing the debt amortization schedule. Your opening balance will be of that security deposit will be 567. On that you will apply 12% interest rate to increase your value of your security deposit, so that at the end of 5 years this becomes 10 lakh gradually. So if you see, the interest over a 5-year period of time is 4,32,573 rupees, which is exactly the same as the prepaid amortization. But the difference is prepaid amortization is equal, whereas the interest income is basically in this case is increasing. right? So it is not in the same pattern, but total it will type. Both has to type. Because what are you doing essentially? The discounted value you are carrying as the security deposit, and the discount element have two components, prepaid as well as interest income. So on initial recognition, what you will do? On initial recognition, deposit you will be debiting at 567, which is the discounted value. Second debit would be prepaid rent, which is the differential between 10 lakh minus 567. And in subsequent measurement, you will increase security deposit by this interest. Security deposit is an asset. You will debit and increase your asset security deposit by 68,091 in first year, and then credit interest income. So this credit interest income will go to credit of your P&L account. But then you will also have to debit rent to amortize the, so second entry is debit lease rent, credit prepaid. So that in this process you will nullify the effect of the prepaid rent. Prepaid rent will be zeroed out in next 5 years, but correspondingly you will keep debiting your rent expense. And you will keep repeating these entries year 2 to 5. Significant change? Now, since sir asked about tax, let me ask you one more question. Today, day 1, you have given 567. In your books you have recorded 567. That day happens to be your year end. When you go for balance confirmation, what will you ask? Auditor will ask for balance confirmation. No, is it 10 lakhs or 567? Practical question. Yeah, there is. So, I am saying, assuming you are in Ind AS, the other side is not in Ind AS, then if the other side is not in his books, it's 10 lakhs. In your books, 567. So there is a workaround, perhaps. I mean, this is just a practical, there is nothing in the standard. Practically, what you can say, when you are rolling out the balance confirmation, you may say, balance as per my books and records. Records include Excel file also. Right? You can say 10 lakhs. Right? That's all. So, what I am trying to drive home here is that there are a lot of changes. This area, financial instruments, is a significant change. We will see one more example on how life is going to change for financial instruments. So let's take an example of convertible debt, convertible bond. What happens in a convertible bond? Essentially, there are two things. You have an option, in most cases, you will have an option to convert your debt into equity. Okay? So in that case, what this is actually in the nature of a compound. Again, it's a common sense knowledge. When you have a convertible bond, the interest rate will be lesser compared to a normal plain vanilla bond. Right? So, what this standard tells you, that if you have a scenario where you have a hybrid instrument or a compound instrument which consists of both equity element as well as the debt element, you split what is your debt element, what is your cost, your equity element. And the way we have to go about is, you first look at of the total amount, what is your debt component. Total minus debt is your equity. So assuming 10 lakh is the total, face value of a compound instrument. If the debt component happens to be 8 lakhs, residual 10 minus 8, 2 lakh is your equity. And the equity is not re-looked at again. That's a constant number throughout the life of that instrument. We will see with an example. It will be easier to explain, and then if required, we will come back to these slides. This slide is nothing but what we will be talking on these. I have given whatever is in the previous slide, I have given here by way of steps, the series. Okay? And if required, we will come back to the previous slide. So see, in this case, what is happening? CD Corp has issued 2,000 convertible debentures with a face value of 1,000 each debenture at par. 20 lakhs is your face value. The debenture carry an interest rate of 6% per annum, payable in arrears, which means at the end of the year. It has a term of 3 years. When debentures are issued, prevailing market interest rate for similar debenture without conversion option 9%. That's what I was saying. Your plain vanilla bond has 9% rate, whereas your convertible debenture has 6% rate. Okay, so and each debenture is convertible at the time of maturity into 250 equity shares. Now, what this says, it's a compound, or hybrid instrument, which has both equity and the debt component. So first, what you should do in this case is step 1. Whatever is the contractual cash flows, in this example 6% on 20 lakhs, that's your contractual coupon. You look at what is your contractual cash flows. 1,20,000 in each of the 3 years will be your contractual coupon. At the end of 3 years, on top of that 20 lakhs will be your repayment. That's your contractual cash flows. That you discount at the market rate of 9%, which was applicable to a plain vanilla debenture. That discounted value will give you fair value of this liability component. So, out of that 20 lakh, whatever is the discounted value, assume 18 lakhs for the sake of discussion, 20 lakh minus 18 lakhs, balance 2 lakhs is your equity and 18 lakhs is your debt. And again the same principle of debt amortization which we saw will have to apply on that 18 lakhs. Okay, so let's see here. It says step 1, compute cash inflows and outflows as per the contractual terms. Then discount these cash flows at market interest rate, which is 9%. The discounted value which will arrive in step 2 is the fair value of the liability component. Then in step 4, total minus step 3, fair value of the liability component, that will give you fair value of the equity component. Okay, let's see the computation, how does it work. So if you see, basically year 1, 2 and 3, 1,20,000 is your interest cash flows and 20 lakhs is your principal repayment. Total of these is your total cash flows associated with this instrument. This you are discounting at 9%, which is the market rate. The discounted value happens to be 18,48,000. So 20 lakhs minus 1848 is your equity.
See, as long as you are able to get a comparable rate of
That will be there, sir.
It's not there in all cases. Let me tell you, there are some old instruments like a 100-year bullet bond borrowed by Reliance and all,
Yeah.
where I don't know how you would...
Yeah, in that scenario, if we do not have, we'll have to kind of estimate that. So to that extent, judgments will be there. These cannot be ruled out. But then, as long as you have an objective evidence of or a comparable instrument, but then comparable also has its own meaning. Comparable risk credit rating,
Exactly.
all of those things, those issues are there. But then again, those subjectivities would be there. But what we are trying to
See, I'm agreeable with the methodology, that
Yes.
is very clear. It
Yes.
is only these kind of...
practical challenges will be there. I agree, 100%. I agree. Okay, so now once you have discounted that, how do you do the accounting for debt? That is the last piece on this. If you see here, again same principle which we discussed. This 1848, you will start with that opening liability, which is the fair value of the liability component, and then here if you see 9% is what we are using. That is the market rate of interest. On that you will do the interest computation. Cash payout will be as per the contractual obligation. Eventually it will become 0. So in this case, the total interest over 3 years which you will recognize is 511 and not 3,60,000. Contractually you are supposed to recognize 360, actually recognizing 511. Fair enough? Good enough for these newer areas. Let's see lease accounting. Now this is standard. Right now we have an exposure draft. We do not have the standard fully notified, but essentially it is based on IASB's global standard IFRS 16 related to leases. Let's see how things are going to change. Okay. So if you see on the left hand side, these top two bullets, they are from the global perspective, and the bottom side in the same bucket is on Ind AS. So in January 2016, IASB issued globally IFRS 16, which replaces all existing lease accounting literature globally, which is IAS 17 and the related interpretations. Corresponding to that, in July 2017, we have issued in India exposure draft on Ind AS 116, which will be expected to be effective from next financial year, April 2019. Globally, this standard is getting impacted from already have started, effective date being 1st January 2019. So IFRS 16 globally has already been effective from 1st of January this year. But an earlier application is not permitted. So what would be the headline impact? What would be the big ticket changes which one can visualize or one can expect when the new accounting standard comes in? Now, today, as we are aware that we have classification of lease from the lessee's perspective, you say differentiate between operating lease and finance lease. Under the new standard, as far as the lessee is concerned, this distinction in most cases will go, which means you will not have operating leases anymore. All leases will be onto the books of the lessee. You have to bring all the leases onto the books of the lessee. So lessee will have a single on-balance sheet accounting model for all leases. So operating lease no longer will be there. When I say all or almost all, there are two exemptions which are given. In only those two cases, you may not account for the leases as a lessee in your books as a finance lease, or you will not capitalize those leases. Only in two situations. In case of leases of short-term nature, typically up to less than 12 months, and low value assets. Only these two exceptions are given. Otherwise, practically all leases on the books of the lessee will need to be capitalized. Lesser accounting is relatively unchanged. It will continue to be the way it was earlier. Again, this standard will bring in a lot of enhanced disclosure requirements for both the lessor as well as the lessee. And we will see subsequently it will have a wide-ranging change, impact on businesses, your margins, your ratios, all of them are likely to change. So let's see from
case of lease of land and building.
Yes.
Typically. Normally the rentals only realize something like 3%, 2%
yes.
value.
Yes.
Are we saying now onwards we'll have to bring those assets into the book?
So yes, certainly yes. Let's see, this is the framework.
Because I thought Australia and others said in the standard that they will not be bringing in such assets into the book.
No. So okay. So we have a unified, literature. We have to look at. This is the core of the entire standard. If there is a lease or the agreement contains a lease for a lessee, other than two exemptions, which is short-term leases and low-value assets, you have to capitalize those. So let's see what this standard says, that to determine if there is a lease, you have to look at first question you have to ask, is there an identified asset? If the answer is no, if you do not have an identified asset, there is no lease. There cannot be a lease because the lease has to be for an identified asset. Okay? If there is no lease, there is no identified asset, no lease.
But under clause 2, which is there, all leased property and building will walk out because of the simple fact that you cannot be sucking out the life of the building during the. If the value of is 1 crore.
No. So let me complete. Then we will. So first question is there an identified asset? If our answer is yes, next question is, does the customer has a right to obtain substantially all economic benefit from the use of identified? It does not say through the life, throughout the period of use. So if the period of use is 10 years, we are only talking about 10 years, not the life of the.
The life of the building will be 70, 80 years.
Could be.
That is where it goes out.
So there is a mechanism in terms of how would you capitalize. Okay. So that mechanism. Let's wait for this to conclude, and then we'll pick up this. Let me first complete what this standard says. So if the if the asset is identified, next question is whether as a customer, do I have the right to obtain substantially all economic benefit from the use of that identified asset throughout the period of that use, not throughout the life of that, eventual life of that asset. No, it is only throughout the period of my use. If the answer is yes, one more question you to ask, does the customer or the supplier, who has the right to direct? So assume I have an arrangement. Once that arrangement is in place, whether I as a customer has the right to how and for what purpose that asset will be used. So that identified asset, will I be using for my warehouse or my office or like that? So do how and for what purpose that identified asset will be used throughout the period of use. Now this could be three possibilities. That either the customer will have the right, the supplier will have the right, or it is predetermined. So if it is the supplier, you do not control, you do not have the lease. But if it is the customer, it's a lease. But the third scenario here, if it is neither how and what purpose is determined, is not predetermined, then next question which you ask, does the customer, me who is taking that on lease, whether I have the right to operate the asset throughout the period of use without the supplier having the right to change those operating instructions. He cannot intervene. If the supplier cannot intervene, it is me who will be deciding how I should be using. If the answer is yes, it is a lease. If the answer is no, one more question you have to still ask, okay, is that do the customer, whether it is, the identified asset has been designed in such a way that the customer has designed that asset in a way that predetermines how and for what purpose the asset will be used throughout the period of use. If the answer is yes, it's a lease. If it is no, it is not a lease. So essentially, from a balance sheet perspective, the entire right to use of the asset would be brought into the books. Just like what you do finance lease today. What you do, you capitalize the present value of the lease obligations for the period of lease. Yes, sir.
Does the situation change in case the company has hired a plant?
Hired a
Plant, manufacturing production facility.
Yes.
Right? Where the machine.
Substantial period quantity. Even today in India, without this standard also, that arrangement is likely to fall into a lease. Even today. Because essentially what is doing? It's like it is essentially in the nature of a lease, 100% of the buyout or the significant output, you only are assuming. You are directing what product the person has to produce. So even today, those arrangements are likely to fall under lease. And that will continue to be under this.
Impact area for the government.
Exactly. Okay. So essentially what will happen is from a lessee's perspective, what we do currently in finance lease is what will be the case for all the leases. Operating lease as a concept will no longer be there, and only two exceptions would be in terms of short-term leases and leases of low value assets. And how do you capitalize? This is the formula which is given in the standard. Basically, your lease liability, initial direct cost, all of these you will be prepaid lease rental if it is there. All of those you will be considering as part of your right of use asset, and correspondingly lease liability. So essentially, you will have your assets as well as the liability. Asset you will depreciate over the lease life, and liability same way as you do currently. You will increase the liability and keep paying the lesser. So what will be the impact in this case? Companies with operating leases currently, which have on transition, all the existing leases also will have to be brought into the books. So the companies with operating leases will appear to be more asset rich because all you will be capitalizing is as your asset. But then also you will be heavily indebted because correspondingly you have to also recognize liability. Okay? And in terms of the profit and loss account today, let's say we building, you do the straight lining of the lease rental. So in place of the straight line lease rent, now you will see a decline in the charge in the P&L with front loading in the initial years. Right? That's what you will see. So this would impact your P&L, though on a total life basis it may not, but the pattern of the impact on profit on P&L account will change, where you will see or you are expected to do front loading of P&L.
I understand the US gap also has
Yes, same.
highlight a little bit on that. There is a lot of pharma companies here maybe.
Yeah, see US gap, and in fact when this standard was issued, it was started as a both, this as well as the revenue standard both. The FASB US gap as well as the IASB from IFRS perspective both came out with a similar standard. However, as things have progressed, depending upon the implementation challenges, there are certain divergences which the FASB is now taking some stand which are slightly different from what you have under IFRS, but more or less if you look at, they are on the similar footing. At least that's the way they started. And as we discussed, this will have the impact on your profit and the ratios. Another important area which will impact is consolidation. Now, before we get into the slide, let me just give you some perspective, and then we can get into the slides, depending upon how much time we have. Okay. Now, today when you do the consolidation, it is essentially based on who is controlling how much. If you have more than 50% shares, or if you have composition control on the composition of the board. These are the two major criteria basis which you decide whether consolidation has to happen or not. Now, of course, these are important criteria, but under Ind AS and IFRS, consolidation is likely to have a huge change. Okay, we will see this. This slide only just give you a prelude that you may have multiple scenarios, multiple where you can have, let's say, holding subsidiary kind of relationship. You may have associates relationship, you may have joint arrangement or other instruments. Now, the percentage of holding, in each case, is just an indicative number. That is not the only criteria by which you will decide whether consolidation has to happen or not. So let's see what it is. Now, under Ind AS 110.
Yes.
How
Are you completing?
much time? Okay, so let me just do things. Slides are there. In the next 5 minutes would be okay? 5-7 minutes? Okay. What I will do, the slides are there. Two things which I will tell, okay? Control, if you see this is the core of the entire standard. What it says? That consolidation is no longer dependent upon how much percentage of holding you have. This is one of the factors. So if you have a scenario where you are holding less than 50%, but there are contributing factors, let's say you have a de facto control, or you have potential voting rights which are substantive, you can use those rights even today, then you have control, and if you have control, you have no choice but to consolidate. Other side is also possible. You may have less than 50% shareholding, but there may be contributing factors in the sense, let's say contractually you are able to control. Then in that case, yes, you have, even if you have less than 50%, you are in a position to control, and then you have to consolidate. Okay, so let's say you have only 35% holding. Rest of the holding is scattered throughout India, and let's say in the recent meetings it has been proved that the balance 65% shareholders have not been able to get together and block your way. Then in that case, de facto you are controlling. So that those parameters one need to look at, and accordingly the impact would be, today if you are consolidating some entity, you may no longer be consolidating, and vice versa. Today you may not be consolidating, you may have to consolidate just because you have contributing factors which say that you are actually controlling. And the other big area is business combination. I'll just give a classic example and then we'll stop there, okay? If you remember, many years back there was a merger between ICICI Bank. There are a lot of things which are there, but I think let's understand this will be, this illustration will help you in understanding what we are saying. So many years back there was a merger between ICICI Bank and ICICI Limited. What happened? In India we said ICICI Bank has acquired ICICI Limited. But was that the real case? It was not. Because if you look at the top management, Mr. Kamath, who was CEO of ICICI Limited continued to be the CEO of combined entity. Mr. Vogel was the chairman of the board of ICICI Limited, continued to be the chairman of the combined entity. Former shareholders of ICICI Limited, close to 73%, continued to be shareholders, majority shareholders of the combined entity. So what has happened? Actually, it is the ICICI Limited that has acquired ICICI Bank, not ICICI Bank. So what has happened in India, we reported as if ICICI Bank has acquired ICICI Limited, but the same transaction, when ICICI reported it to the US stock exchanges, they said ICICI Limited has acquired ICICI Bank. Reversal. And why it is important? It is important to understand who has acquired whom, because it is the balance sheet of the acquirer, the target company, that needs to be fair value, not the person who is acquiring. What has happened? It is the ICICI Bank's balance sheet that needs to be fair value, not ICICI Limited. Whereas in India, when Indian GAAP, we applied the other way. When it comes to US reporting, we applied as if ICICI Bank has been taken over by ICICI Limited. Now, whether or not anything is reported or recorded in the books of in the balance sheet of ICICI Bank in this example, still if that has a value, let's say you are paying purchase consideration of 100 rupees and net assets is only 70 rupees, what is the balance? 30 rupees. The standard requires you to find out why you are paying the 30 rupees. Are there any intangibles? Even if those intangibles are not recorded in the books of the target company, you record in your books, and then the difference between the purchase consideration and what you are paying, that's your goodwill. And that goodwill on acquisition is not amortized ever. It is only tested for impairment. So these are significant changes which we will see. Contingent consideration. So if you are giving some contingent consideration, those contingent consideration should also be included as part of purchase consideration. With these limited words, given the time which we had, we have the slides, so you can just go through it. Whatever we discussed, all of these are kind of mentioned here. Feel free to reach out to me in case you have any further doubts on this. And as I said at the end, I have included some, the annexes in terms of how the transition impact has been. So there was a research publication. I have taken the extracts from there, how each of these parameters have been impacted, and in some amount of overview of the pharma industry in terms of how, of course, you guys are the experts, so I need not tell, but as an appendix, I have included this. Thank you very much for your time and patient hearing. Feel free to reach out to me in case you